This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 31. Does misinformation feed capitalism?
Welcome to the Debunking Economics Podcast. Now, the economy is, of course, based on information. We need information to invest in companies, and we need to do that to fund growth. But it's always a bit of a punt. The company could collapse and we lose our money. So we research and make sure we invest wisely. Now, in an ideal world, we'll know everything there is to know about companies we invest in. But in reality, we'll never know as much as the people running the company. So gambling is a key part of the way capitalism works. But what if you reduced or removed that gamble? To talk about that, Professor Steve Keen is with us again. Well, let's start, Steve, with this idea of information. It is uneven, isn't it? The head of a business seeking funding obviously knows a lot more about the company than the investor.
Yeah, well, it's obviously true, but at the same time they can delude themselves. Not forget about the capacity for top managers to maintain a yes man bubble and believe their own BS.
Yeah, that's true.
But the fundamental point of reference, the question is compared to what? And the reason that asymmetric information, which is the main reason Joe Stiglitz got his Nobel Prize, the reason it's been such a standout success in mainstream economics is their point of reference is assume everybody knows everything. When they talk about perfect information, they literally mean, everybody knows everything about anything. And when somebody pointed out they had to involve the future, in that case, they've got a model that lets them predict the future accurately. Not a problem. Total off the tree fantasy stuff. I once had a guy, a conventional young conventional neoclassical economist, getting really angry at my presentation in a seminar. And as we're walking out, we're continuing having an argument, and he calls behind me as I'm walking away from him. He says, "We've got to make some simplifying assumptions." And I simply said back, "Mate, you've got to learn the difference between a simplifying assumption and a fantasy." Now, the neoclassical position is a fantasy. The good point of reference, and this is one reason I have a fair bit of time occasionally for Austrian approaches to economics, is Hayek's point that we know very little information and we have a rough idea of what applies to our own little immediate circumstances, but not much better than that. The big bad world out there is unknown by most of us, so we'll make various extrapolations to try to handle what's going on in the giant unknown that's the majority of the information in which we live. But the market, he says, enables us to aggregate these tiny amounts of information and overall reach something which is reasonably intelligent. And that's a much more sensible perspective on what the market does than the mainstream has. Now, in that situation, the asymmetric information that an individual company has over us is, yes, it's an advantage, but not quite the same advantage as it was if your point of reference is perfect information versus asymmetric information.
If we're here, let's live in this fantasy world just for a second. Imagine if in this fantasy world we did have perfect information about where we are now and also, perfect information about the future. We could all see the future. That would mean that there would be no risk involved in investments. And that would mean, just finishing off on this point, that if I went to the bank and I had $10 in it and I said, look, I'd like to invest in this company because we all know it's going to grow really quickly and it's not, it's no gamble on your part to lend me this money. There's going to be no difference to that bank lending that money to somebody who's got £10 in the bank versus someone who's got £10 million in the bank because they have access to the same information. This is a surefire win. Let's lend to whoever wants to invest in this company.
Well, you've actually hit on a rather interesting point here, because if we had perfect information, then there would be no trading.
Yeah, well, that's what I was trying to get to. Exactly. The whole point about capitalism is it's based on misinformation, isn't it? It almost needs it to survive.
Now, the ironic thing is, if you read, I remember reading a paper by Hal Varian, who wrote the leading textbook on microeconomics for advanced courses back in the 1970s and 80s, and he's only recently been gazumped by guys even more bizarre than him, based in Spain, called Mascalel. But I was reading one of his papers attempting to explain the stock market, and I was thinking, mate, you're heading down a very narrow track here. He literally said it in the paper, said, of course this hypothesis implies that no trading actually occurs. We'll jump over that and go to the next point of the model. And the same thing every time you look at it, like for Milton Friedman, when Milton Friedman talked about what causes inflation, when he had his helicopter analogy, the helicopters flying over and dropping the money.
Yep.
And it came down, nobody was actually had made no difference to trading. People just put their prices up because they thought prices were going to rise. There was no trading involved. So their theory ends up, they're trying to explain the market economy, and they have a model of the market economy which ends up saying no trading occurs.
So the point
it's insanely stupid.
Right. So the point I was trying to lead to, though, was that if we all had perfect information, it wouldn't. As you're saying, no trading would happen because there's no element of gamble in there. But because we do have access to some information, which helps you make a more measured choice on who to invest in and what's going to give you the biggest return. The access to that information is key.
Yeah,
and it seems, and access to that information is largely driven, I suspect, by how much money you've got and how much you can afford to buy and who you know.
Yeah, and information in the real world some form of information is vital, not because it's necessarily going to tell you what's going to happen in the future, but because you realise how little you know, and therefore trying to find to know something more is always seen as advantageous. Again, the reference point of almost total ignorance means, well, obviously I'm going to pay for some better information. The reference point of infinite knowledge means who cares about this stuff? What do people even bother advertising? And this is the intellectually false idea of having to start from the concept of perfect information. But in the real world, when we know that we don't know most of what matters, then the question is, well, is information actually worthwhile? But certainly, I know that I don't know a large amount. Whereas, in terms of the previous Donald Rumsfeld rather than Trump, neoclassical economics presumes we live in a world of known knowns. And we don't.
So if it's the domain of the rich, and the rich are making themselves richer, I mean, part of that equation obviously is because they have the money to invest. They can leverage against the equity that they hold. But on the other side, it's because they have access to that information. I mean, surely, a large part of the wealth that is generated in an economy is people making money from their investments. You could, governments, as a government policy, you could try and equalize income if you could change the education levels associated with investing.
No, not really.
Because of the requirement for equity is too strong?
No, because it's too damn difficult to do. I mean, most of us. This is one thing about information overload is one of the issues in the capitalist economy as well. I love one. So, what's his name? The Australian Clive James.
Yep.
Went to America and made a point of staring at a list of options inside a hamburger joint in America. Well, I think there were 10,000 different ways you could have your hot dog. Do you want this or that? Do you want fries with that? Et cetera, et cetera. You do your binary choice calculations, and you get 2 to the 20 pretty rapidly out of that. And there's just too many potential variations, even on a damn hamburger, to be. So I'll have number 3, thanks. So information overload is more the problem rather than processing it. And the other intriguing thing is that people normally, like what you're saying here, is information is biased in favour of the rich, and therefore rich are going to make more money out of it. Maybe we should try to equalise the information. We simply haven't got time to process the information. But the other side of it is what happens with trade in terms of what is a wage? Is a wage more or less than the value that the worker is adding? And most people would go with the usual, even people who aren't Marxists, when they go, it's got to be, the workers get exploited. No. In fact, if you read Marx properly, as of course yours truly has done, Marx talks about the minimum wage being the value which workers should get is the minimum wage, not the actual wage. So Marx thought workers would get more than their value. But lo and behold, physicists have confirmed this using their statistical approaches to analysing economic data. I got 2 separate papers sent to me to referee at one stage, both of which had found that in trying to do a model of investment earnings versus trading earnings as ways of making money, with the rich making out of investment and largely the workers making out of trade by selling their labour, the only way that the physicists could fit the data was by presuming that the trade was biased in favour of the poor.
Right.
So that was empirically the case. So in that sense, workers get paid more than they would get if they were paid just their value, their contribution to production. And that actually balances, not as completely obviously, but it balances the information asymmetry in the other direction. So you're better off trying to say how do we get another way of getting the money to the workers, not by trying to improve the information and get them to compete with the capitalists, where information and wealth are their advantages. Ain't going to happen, and we simply haven't got time to do it.
Right. Okay. So, what about market crashes? If we had better information, would we be able to avoid the crashes that obviously, we've talked before about they're unavoidable, but could we lessen the chance? How much of what happens that is detrimental in the economy is the result of information that is either flawed or incomplete?
Oh, well, it's that's always a contributor, but the reality is information has to be incomplete in that sense, because a huge part of what we're hoping to profit out of depends on what happens in the future, which we can't know, and that applies to everybody, including capitalists at the top end of the scale. And as Keynes brilliantly put it, we end up falling back on a set of conventions which are going to fail, but there's nothing else we can do. We assume that the recent past is a reasonable guide to the future, which leads, of course, we never see turning points coming.
Yeah.
We accept that market prices are accurate, which, of course, we don't see market crashes coming. And the final one says, we endeavour to fall back on the judgment of the rest of the world, which is perhaps better informed. Now, of course, herd behaviour comes out of that.
Sure.
And you're not going to, if you improve it by trying to improve the information, then it's a bit like saying, look, I know that of all the minimal number of life rafts on the Titanic, the best built one is number 12. Everybody climbs into 12, and 12 sinks faster than the Titanic itself. So you can't really use information in that sense to evade the problem. What you've got to do is evade getting into the situation that causes crashes in the first place. Right,
but of which a large part is gambling, isn't it? And gambling is sort of like we gamble based on a modicum of information. If I'm betting on racehorses, I might study the form, but I never know what the outcome is. But I'm still a gambler, and if I'm particularly bullish, I'll just put more money in and create bigger peaks.
Yeah, but I think trying to address it by giving us more information doesn't address the fallacy that we have uncertainty about the future, and our speculations about that are going to be the major determinant of where we put our money fundamentally, and that's going to have herd behaviour to it. So I think we're just accepting that that's the case in capitalism is better than thinking we can actually counter it by more information. To quote one of my favourite rejection notices from an editor of a leading journal, the American Economic Review Macro, when I was having a go at him rejecting my paper unrefereed on modelling the financial crisis, he literally wrote to me at one stage, but what if they get more information about the future? How would that change things?
Right, okay.
It'd change the nature of reality, mate.
I think it would. That's all we need to do is travel faster than the speed of light, and
that's all we need to do.
That's all. Exactly. Very simple process. All right.
Simple.
At a more granular level, though, you'd have to argue that getting more accurate information out of companies. I guess I'm almost answering this question as I ask it, of course. But we know when we read annual reports or we read information memorandums that come out of companies that are seeking funds, it's what's not said that is the most damaging information, isn't it? It's the stuff that they are withholding.
Yeah, and that's the whole idea that you can stabilise the market by having more information. Is what led people to think that all the stock picking companies and all the professionals doing it would mean the market would never have a crash. And the first person to articulate that theory soundly was one Irving Fisher.
And I guess the answer is it's always going to be a punt. The people who are going to make that gamble are going to be the people who've got the money, who can afford to lose it.
Yeah, and I'd rather have them trying it than workers.
Fair enough. Like you and me, Steve. All right, okay. I think we've sort of finished that one off then. There'll always be misinformation. There'll always be a shortage of information, but it's not necessarily a bad thing because if you're striving for it, you're striving for the impossible. You're striving to understand the future. Yeah.
Yep.
All right, appreciate your time. Talk again soon.
Okay, mate, bye.
And who does it really hit? It hits those people who can most afford it. Maybe there's bigger issues, bigger fish to fry when we're looking at things like, for example, income disparity. That's it for this edition of the Debunking Economics podcast. I'm Phil Dobbie. We'll catch you again with Professor Steve Keen very soon. Thanks for listening.